Now, a couple quick other terms, I'm not going to break them down, but important. Net cash flow is the money left over after you pay the mortgage. Not your net operating income, right? You pay your mortgage, net cash flow, right? And if it's a positive number, you may have to pay some tax on it. So keep that in mind. This is important. Cash on cash return. This is the measure of return. This is going to say, hey, you got cash flow, but is this cash flow good enough, right? It's always got to be a standard. Is it good enough? Yeah? Hey, you made it to the playoffs, but did you make it to the Super Bowl? Sorry, Niner fans. I had to throw that in. But it's a measure, okay? And this is how you come up with that number. You take the down payment plus your closing costs, right? How many know we got closing costs in addition to our down payment? Those are typically mortgage fees. The down payment plus your closing costs, right? That's your cash invested, right? Well, how you're going to get there is you're going to take the net cash flow, the money you make every year after you pay the mortgage, divide that by the down payment and closing costs, and that's going to get you a percentage, right? A general rule of thumb, you can't use this in San Francisco, but a general rule of thumb, I like to see properties generate at least a 10% cash on cash return. As the market gets tight, that's harder to achieve. But you want to at least get 10% of your money in general. Now, hey, we're in the Bay Area. That's that. When I first started in real estate in 2003, that was hard to find in the Bay Area. So I started doing deals out of the state, right? Now you actually can find that here in Oakland and other parts of the Bay. Probably not San Francisco unless you got an inside track. But every market's different. Every investor is different. You got to figure out what your minimum cash on cash return is going to be, to whether you can evaluate whether this is a good deal or bad deal. Also, lastly, internal rate of return. I'm not going to go into this. It's a little bit more technical. Institutions more look at this. But basically, it's the total rate of return on the initial investment on an annual basis once the property is sold or over the holding period. So the internal rate of return looks at the cash flow, looks at the mortgage pay down every year. You should be paying the mortgage down a little bit, whether the property goes up or down in value, and then the tax benefit. Internal rate of return looks at everything. So you also want to have an idea of what the appreciation is in the market, the cap rate is in the market, not just the cash flow. You lead with the cash flow and then look at other things. So these are the cash flow, cash on cash return, IRR, also, which is called internal rate of return, IRR, if you hear somebody say that. These are the key measures that are going to dictate whether the deal is good or bad. Make sense? All right, I'm blasting through it because we just got a few more minutes. Okay, couple strategies, and this is more, there's a million strategies and techniques and stuff like that. I'm going to cover two main ways of buying real estate. First way is buying on your own, right? So, but then the other one I'm going to talk about is buying with the group or buying with others, right? When you buy on your own, there's a million different strategies and techniques you can go into, right? This page can't hold them all. I put up here a long time ago, REOs, short sales, distress sales. REOs are disappearing. They're almost going down. They're not, but real estate owned by the bank is what REO means. There's not a lot of them anymore. Short sales, there's not a lot of them anymore. They're out there, but not like it was a few years ago. Distressed property. This is something. Distressed property, obviously a short sale REO is distressed, but also something that needs a lot of work, something that might be going through bankruptcy, divorce, you name it, whatever distress, probate, right? There's some sort of distress, so the property should be sold at a discount. You want to look for these type of things. Here's another thing, note acquisition, okay? It's called the loan to own strategy. Basically, you can buy a loan as an investor from a bank or a lender at a discount, of course, and then you become a lender. And at that point, you can make progress towards taking the property back, via foreclosure or whatever, deed in lieu, so on and so forth. Or you can just, if you bought the loan at a cheap enough price, you can get the income from the property, right? Say you bought a loan that was a $100,000 loan. You bought it for $50,000, but the rate's 10% on $100,000. So now that income coming into you is pretty attractive. Or somebody's about to go into foreclosure, the lender wants to sell a loan just to get off, you buy it at a discount, and you finish off the foreclosure, you buy the property. It's basically the best way you can buy a property at a discount. Understand though, it's a little bit risky. You become a lender, so you need to know the laws, you have an attorney, all that. But it's a good strategy. Also, wholesaling, when you buy it, you get a contract together. There's a couple wholesalers I know here, Deb, I know you do a lot of wholesaling. You get a property under contract, and then you sell the contract in essence to another investor who's going to get it and then flip it. And you make a fee for doing that. That's called wholesaling. Buying and holding for cash flow, not necessarily a strategy more than it is for a plan. That's just buying rental property for the purpose of achieving the income, right? Buying and flipping. We talked about that at first. That's when you buy something for the purpose of the resale, the profit, not for the income. There's also another good way of making money. You just need to know what you're doing. Buy, hold, and exchange. This is a little bit different. Or buy, hold, and structured sale. But buy, hold, and when you sell, you ain't paying taxes. You would roll it up to another property or do a structured sale to where you're not paying the capital gains on that sale. You're deferring it, right? When you buy and flip, you're paying that. And you're going to pay ordinary income tax, but you're paying tax. So buy, hold, and exchange with structured sale is a way for you to preserve the wealth, because like Matthew said, the biggest killer of wealth is taxes. Probably the biggest, I have to argue with that, probably the biggest killer of wealth is procrastination.
Yes,
and not taking advantage of opportunities. That's why it's important that y'all here tonight. Whether you take a point from tonight or not, you are investing your time into educating yourself to do something. And so while taxes do kill our wealth though. So, but just understand that when you exchange up, you defer the wealth. You defer the taxes. And it's a good strategy. Also, contract for deed, lease option, seller financing, joint venture. These are creative financing techniques for you to be able to acquire property. Things that you need to be aware of, that you're responsible for the financing. If you get a loan, you're probably going to have to sign a personal guarantee. Y'all know what that means? It means if the lender forecloses, not only can they foreclose, they can also come in and take some stuff from you. All right? It's rare that a lender in California does that because they have to go through what's called judicial foreclosure, but it's possible. Okay, just know the risk that you're dealing with. You got to come up with the down payment, and you're liable for pretty much everything that goes on at the property. All right. So I can go on and on with what you can do when you buy on your own. Right. But here's what what I'm excited about and what we're starting to do more is co-investing with partners and co-investing with sponsors. Even Don Trump will go out and raise money. He may not have partners, but he'll use another form of money, a fund's money, and institutions' money to acquire that property. Right? It's a way of doing more than you can do individually. Right? You put your money together, so maybe you couldn't buy a skyscraper together, but a few investors together in a fund, now you can do more than you could by yourself. All right? Yeah, absolutely. And you're just using leverage to accomplish more. It's been done from the beginning of business to now. And I think I won't go into too many details because we're right at that 8:30 point. But the bottom line is, this is a way for you to go out and acquire. You can do all the same things that we talked about before, but now when you do it with people, you have an opportunity to be able to do more. Some of the pitfalls. It's not perfect. You're dealing with people, right? It's the technological age, but it's still real estate specifically. It's still a people business. Even if you're leasing an office building, you're leasing to a company. But there's a CEO of that company. There's an HR person. It's a people business. So when you are investing with other people, you got to make sure that the team, the people that you're in with, you can work with, because everything is not peaches and cream. Don't believe the late night seminars. Real estate, it's all good, and you're going to do one deal, and you're a millionaire, and it's all good. And hey, it's going to be some challenges. So therefore, whether you buy individually or with others, make sure it's people that you can lock arms with, and that you can go to war with. Right? You're going to battle with, because you're going to have some things to deal with. So the people you deal with, I would say, is the most important thing. Everything is not going to be peaches and cream. Even a good market, you got to fight for stuff. So the guys, the gals, the people you're working with, it's important. The most important thing you got to look at. But the bottom line is you can do more than you could do individually. All right? So one more slide and I'll let you go. And this is, I took a screenshot, but you can't really, and that is the Open Skyline Lake Merritt. This is out of the National Real Estate Investors, I think it's last month. I think it is January. I think it's January's edition.
January 17th.
Right, January 17th, National Real Estate Investor. It's a magazine, it's a real good magazine for any of your investors out there, I suggest it. I had to show this to y'all because this is the top 10 multifamily markets in the country. Y'all know who number one? Oakland, California. What? No, can you read that, Mr. Williams?
We are sexy. What's the name of the magazine?
That's called National Real Estate.
Oakland is number one. National Real Estate.
National Real Estate Investor. Yeah, I was gonna say it's the National Real Estate Investor, and they have an online website. I get all this stuff online, but if you want to do print, you can do that too. But I just wanted to, and look, 7 out of the top 10 cities in California. Now, if you'd have did this 5 years ago, we wouldn't see there would have been no California cities on there. The good part of this crash is that, I know a lot of people lost properties, okay, but the silver lining out of this is that prices dropped significantly. Remember I said at the beginning, rents didn't really drop that much. And we live in California. California, there's a lot of people in California. Something like 38, 40 million people, right? California is like a country economy. How many people we got, how much money, the economy and everything. But within California, the Bay Area is the leader of that, of economics, of real estate for sure, and a lot of other things. Within the Bay Area, and where everything's expensive, Oakland is by far the most affordable big city in the Bay Area. Also, Oakland is central.
Transportation.
Absolutely. You can get to anywhere from Oakland. But the big thing, and this article goes into, is that it says it right here, you might not be able to see it, but it says, much of the demand is spillover from San Francisco.
Yeah, because their rents are way too high. They're not sustainable.
San Francisco is ridiculous.
70% renters now.
Yeah.
That can't make a city.
And it's so expensive. But at the same time, it's about 10, 15 minutes from right here. The other night, I took my wife out to this steakhouse in the city. I live in the Oakland Hills. I wanted to say, okay, well, how long on a Friday night did it take to get from Oakland? And Oakland Hills off Keller. So I'm kind of deep towards San Leandro. Man, from my house to when I parked, y'all know how parking is in the city. Right? It was 22 minutes. And this is at 7 o'clock at night.
Yeah.
Right? If you're downtown or West Oakland, it's 10 minutes. If you're on the BART, it could be 5-10 minutes. How easy is it for you to live here, hop on the BART and go to work every day, and come on back here, versus, hey, you're working in the city at Zynga or Twitter or Foursquare, and you paying $2,500 for a studio.
This is where families are actually coming when they're young and whatever, running around, but they make babies, they're coming here.
Because they can afford it.
Because they can be close to their family and have a beautiful life.
And a lot of people is figuring out, like, oh, Oakland, it ain't as bad as I saw on TV. You know what I mean? Now, you got certain neighborhoods.
They don't put the good stuff on TV.
Right, you got certain neighborhoods, it's tough for sure. But the bottom line is, Oakland is number one is the number one multifamily market in the country right now. Also, it's number one in fastest time on the market or quickest time on the market for home sales. It's number one for growth appreciation. They're expecting a 9% growth in home prices here in Oakland this year. I want to show this to y'all, right? Because
they're cheap when you compare them to all the surrounding areas.
When you look at San Jose, when you look at San Francisco, when you look at Napa area, the Peninsula, it's a good place to invest.
I was raised here, but I live on the other side of the hill, and I can tell you, there's absolutely no transportation there. And all of us old people are going to continue flocking because we want to still live, get around.
And listen, I mean, look, everything's around. So, I could go into. I love Oakland. I'm born and raised here, so I love it here. But just looking at the numbers, looking at the economics, and what other people are saying, this is a great place to invest. So, what I would suggest and I suggest y'all to look into Oakland, invest into Oakland. Do business in Oakland. So with that being said, I want to thank y'all for coming out tonight. I think this has been very productive. I learned a lot. Hope y'all learned a lot. Let's just do it. If you have questions, just stick around. I know I'm going to get everybody out of here. If you guys got to go, if you got questions, just stick around. But I want to say thank you and best of success in investing. And I'm picking the Seahawks myself.
What's your